Welcome to MarketTamer.com. It is Friday, July 10th. We're looking at the S&P 500 in the context of the S&P 500 spiders, that is the SPY, and I'll refer to that later on in this video. Note that the 200-day moving average is still just about holding. However, the neckline that we discussed earlier in the week, right around the 90 region, has broken. That's obviously a significant negative, given that we had a head and shoulders pattern form. If we move on and take a look at the volatility index, what's interesting here is that we've had a series of lower lows and lower highs all the way down here until just recently in the past few days, where these breaks here above the 50-day and above the downtrending line indicate that potentially this pattern of decreasing volatility, which has accompanied the market rally, may well be ending, and that obviously aligns also with the break in the head and shoulders neckline. Moving on, we'll take a look at the NASDAQ. The NASDAQ has actually shown outperformance all the way up and has suffered generally the most on the way down. With that said, it's the index that is most above its 200-day moving average, still very substantially above it. And while we see a 50-day moving average moving higher here and flattening out, if we look to the 5-day, the 20-day, and the 200-day, all are pointing down. So it's not to say the market could not rise higher, but certainly all the trend lines are indicating that that is not the case. And our general policy here is not to fight the trend. If the short-term trends are all pointing down, the long-term trend is pointing down, we'll play with the trend, and again I'll refer to that near the end of the video. If we look to the Dow, it's also suffering. It was the index that broke the 200-day, the neckline first, and so that would suggest there's further retracement to go to the downside. We'll have to see exactly how far it could go, but 8,000 would be quite reasonable. After that, we'd be expecting a further few hundred points drop to the downside. We haven't really seen a nail in the coffin on this bearish trend yet, so we're going to remain somewhat cautious, given that some of the oscillators are quite oversold right now, and often there is a bounce after an oversold correction. Let's move on and talk about some of the banks. First one we'll note is Citigroup here. The characteristic of Citigroup earlier in the year was tremendous volatility. You can see from the $3.50 area all the way down to $1, back up to $3.50 in very short order, space of just a few weeks. We had very, very choppy trading, and now what we've seen since late May is a correction. And note that even though this is a correction of only a dollar and change, it's a very substantial correction in percentage terms. That is, people who were looking to take advantage of Citigroup at low prices, potentially they were believing there would be a fundamental shift, which there has not been in the banks, but potentially they were estimating that. They are now down very considerably in percentage terms, even though it just represents $1. So always pay attention to that. These low price stocks can significantly impact portfolios, both up and down, in percentage terms. And that's evident here as well. If we look at a chart, just note this is a logarithmic chart. So you might say, well, this stock has only just bounced back slightly here. But in fact, note that on the logarithmic scale here, from 12, 13 region down to 7 is again almost a 50% haircut. So always watch out for that, and don't be fooled by those logarithmic charts. Finally, I'll just note that we were looking here recently at the S&P. I was pointing out a trade that I'd in fact got into, which was a 93.97 bear call. Note there's only 10 cents of premium right now on that strike 93 position, so there's really not much point in holding it further. All right, with that said, if you have any questions, we'll look forward to you joining us at MarketTamer.com. All the best.